Hey everyone, welcome back to Wealth for You, where we turn steady income into financial freedom. The Singapore way. Now picture this. Every 3 to 6 months, your bank account goes ka-ching. Money comes in without you lifting a finger. Shiok, right? That's the beauty of dividend investing. And today, by popular request from one of our viewers, we're diving into one of Singapore's income favorites. Keppel Infrastructure Trust, or KIT, fresh from its 1H 2025 results, released on 29 July 2025. Is this juicy 8.9% yield too good to be true, or the real deal? Stay till the end, because I'll share whether KIT is a buy, hold, or sell, plus how the coming Fed rate cuts might give it a boost. Like this video so more Singaporeans can see it, and hit subscribe to Wealth for You for more dividend tips. Just a quick disclaimer. This video is for education, not financial advice. Always do your own research before investing. Chapter 1. What is dividend investing? Before we jump into KIT, let's quickly talk about dividend investing. Dividend investing is simple. You buy shares in companies or trusts that share part of their profits with you in cash, called dividends. Think of it like planting a durian tree. You don't chop the tree for wood. You keep it, and every season it gives you durians, hopefully big and juicy ones. In Singapore, REITs and business trusts like KIT are popular because they're legally required to pay out most of their income. That's why income investors love them. Chapter 2. KIT's business in simple terms. So what exactly does KIT do? Unlike a shopping mall, REIT, or an office REIT that relies on tenants and foot traffic, Keppel Infrastructure Trust is a business trust that owns and operates essential infrastructure assets. The kind of things people and businesses simply can't do without. Here's what's in their portfolio. City Energy, Singapore's only town gas provider, powering homes and businesses every day. Keppel Merlimau Kogan Plant, a major electricity generator feeding into Singapore's power grid. Desalination plants, turning seawater into clean drinking water for our taps. Overseas utilities, power and water facilities in Australia and the UK, adding stability through geographic diversification. These aren't nice-to-have luxuries. They're mission-critical services. Rain or shine, recession or boom, people still need gas to cook, electricity for lights, and clean water to drink. That's why KIT's revenue streams are generally stable year after year. Of course, no business is completely risk-free. Changes in regulations, operational hiccups, or market competition could still affect performance. But overall, this is about as defensive as it gets for income-focused investors. Chapter 3. KIT's 1H 2025 Financial Highlights. Alright, let's talk results. And they're quite a mixed bag of strong wins and a few weak spots. Here's the headline. Distributable income, the pool of cash available to pay unit holders, surged 31% year-on-year, from $91 million to $119.4 million. That's a huge jump, especially for a defensive business trust like KIT. DPU, or distribution per unit, basically your dividend per share, crept up 1% to 1.97 cents for the half year. Not massive, but in the income investing world, any increase is good news. Profit made a dramatic turnaround, from a loss of $23.9 million in the same period last year to a $60 million profit this year. That's what we call a U-turn in performance. So, what drove this? Big wins came from the sale of Philippine Coastal, a fair value gain on their AGPC investment, and stronger earnings from Ventura, KMEP, City Energy, and Ixom. The not-so-great side, some wind farms didn't perform as expected, and contributions from KMC and EMK dipped. In short, KIT's first half of 2025 looks strong, with distributable income and profits up sharply. But part of the boost came from one-off events like asset sales and revaluations. So the key question is whether this momentum is sustainable into future periods. Chapter 4. Valuation and Key Metrics. Let's check if KIT is cheap or expensive right now, and I'll use the most updated numbers for a clearer picture. The market cap sits at around 2.5 to 2.6 billion Singapore dollars. That's actually smaller than some might think, but still, it's a significant player in Singapore's income investment space. The PE ratio is roughly 18 to 28 times, depending on which earnings period you use. That might seem high compared to retail or industrial REITs, but for infrastructure trusts, investors tend to focus more on yield and cash flow stability rather than PE multiples. The price-to-book ratio is about 1.5 times, so investors are paying a 50% premium over the accounting value of KIT's assets. This is quite normal for stable, regulated utilities with predictable cash flows. The debt ratio, or leverage, is around 41%. On the higher side, but still comfortably within MAS's 50% limit. That said, in a high-interest environment, every extra percent of debt really matters. Free cash flow is strong and positive, more than covering distributions. This is critical, because in dividend investing, cash flow is king. Profits on paper don't pay your bills, but consistent free cash flow does. Bottom line, KIT doesn't look dirt cheap based on book value or PE, but it's a steady cash-generating machine. For income investors, that reliability often matters more than whether the PE is 15 times or 25 times. Chapter 5. Dividend Yield, History, and Sustainability. Now let's get to the part income investors really care about, the dividends. Based on KIT's latest DPU numbers, the trailing yield is around 8.9% and the forward yield is closer to 9.4%, assuming management maintains the current payout rate. That's a very attractive number in today's market, especially for a stable, essential services business trust. KIT has a long track record of steady distributions. No cuts in recent years, not even during COVID-19. That's a testament to its predictable utility-like cash flows. That said, DPU growth has been modest. There was a dip in 2023, and while the first half of 2025 saw a 1% increase, this is more of a stability story than a growth story. KIT pays out close to 100% of distributable income, which is different from net profit. Distributable income is a cash-based measure, so KIT can maintain high payouts even if accounting profit fluctuates. This high payout ratio is common for infrastructure trusts, but it also means there's little buffer for unexpected shocks. The good news is that most of KIT's income is locked in through long-term contracts in regulated, essential sectors like power, water, and gas. That makes cash flow reliable. The flip side is that future DPU growth will likely depend on acquisitions or operational efficiencies, not just organic growth. Bottom line, KIT's yield is one of the juiciest in Singapore right now and has proven reliable. But sustaining and growing that payout will depend heavily on how well management executes future acquisitions and keeps existing assets performing at their best. Chapter 6. Critical Evaluation. Let's take a balanced look at KIT's first half 2025 scorecard. Positives first. Strong distributable income growth. Up over 31% year-on-year, which is no small feat. Stable essential services. Power, water, and gas don't go out of fashion, even in a recession. Resilient cash flows. Most of KIT's revenue is locked in via long-term contracts, so income remains predictable. But here's the flip side. This half's big jump was boosted by one-off gains, like selling Philippine Coastal and fair value gains from AGPC. Those don't repeat every year, so next half might not look as juicy. There were also some operational hiccups. Some wind farms underperformed, and key plants like Keppel Kogan and EMK contributed less. High leverage, net gearing in the low 40s range, gives less wiggle room if borrowing costs rise or asset values dip. With interest rates still elevated, though potentially easing, debt management will be key. High payout ratio, almost all distributable income goes out as dividends, leaving little buffer for reinvestment or shocks. So yes, KIT is like a good copy, strong and satisfying, but if you're watching your sugar, or in this case debt, you'll want to be mindful of how much condensed milk is in the mix. Chapter 7. Future Prospects and Fed Rate Cuts. Now here's where things get interesting. The U.S. Fed could start cutting rates as soon as September. Why should KIT investors care? Well, lower global rates could ease refinancing costs over time, which is good news when you're carrying over 40% gearing. If bond yields fall, KIT's current 8% plus yield, based on recent prices, could look even more appealing to yield-hungry investors, possibly giving the unit price some support. But let's not get carried away. Rate cuts won't magically erase KIT's other challenges, like its heavy payout ratio, the need for consistently performing assets, and dependence on acquisitions to grow. Lower rates might be a tailwind, but they won't turn KIT into a high-growth rocket overnight. Final thoughts. Buy, hold, or sell. So, buy, hold, or sell. If you already own KIT, it's a decent hold for steady income, especially if you value predictability over big price jumps. If you're new and love the idea of essential service cash flow, you could consider nibbling, but only on dips and with the understanding that growth will be slow and steady, not explosive. This isn't a get-rich-quick counter. Think of it more like your favorite copy from the Hawker Center. It delivers comfort and consistency, but it's not going to suddenly turn into champagne. Keep expectations realistic, and you'll enjoy the ride a lot more. If you found this breakdown useful, give it a thumbs up so more Singaporeans can discover the power of income investing. Subscribe to Wealth for You for more dividend-focused insights and share in the comments. Are you Team KIT or do you prefer REITs like CICT, MLT, or others? Thanks for watching, stay invested, and may your dividends keep flowing.